If a book can change the way you see the world, this is where you'll find it. I'm Kara Chen. Let's explore together the books that truly shape our destinies. Today we'll be reading Trading for a Living, exploring the core principles and fundamentals of trading together. If you think trading is just for Wall Street insiders, Trading for a Living will totally change your mind. The author, Alexander Elder, has a life story straight out of a movie. He graduated from med school in the Soviet Union, worked as a ship's doctor, then moved to the US and started trading with nothing. Using technical analysis and deep psychological insight, he became a top trader on Wall Street. And here's the twist. He's also a practicing psychiatrist. That double background means this book isn't full of cold, robotic formulas. It's a real-world guide that breaks down human behavior and market patterns. Since it came out in 1992, it's been translated into over 30 languages, sold more than 1 million copies, and is practically required reading on Wall Street, often called the survival manual, that can save new traders 5 years of mistakes. But you might be thinking, I'm not a professional trader. Why should I care? Here's the thing. Maybe because you are not a pro that you need this book most. Because at its core, it's not really about buying stocks or trading futures. It's about how to stay calm, clear, and rational when everything around you feels uncertain. Let us talk about one of the most counterintuitive truths in trading. Most people lose money not because they lack skills, but because they lose control of their emotions. Elder shares a powerful example. A surgeon who's cool and precise in the OR, yet lost $250,000 in the market. Why? Because he treated trading like a game of guts and instinct. He'd jump in based on feelings. When he won, he thought he was a genius. When he lost, he doubled down, trying to win it all back. Sound familiar? Like seeing your coworker make money on a fund, so you rush in. Then when it drops, you hold on tight, hoping it'll bounce back. And when it finally goes up, you sell immediately, scared to lose your gains. These behaviors all come from the same inner demon, being dragged around by greed and fear. What makes this book so powerful is how clearly it breaks down these irrational habits. Take the not enough money myth. Lots of people think they'd win if only they had more capital. But the truth? Small accounts fail not because of size, but because of oversized bets and overtrading. It is like trying to put out an oil fire with a glass of water. No matter how much you have, it'll burn out fast. Or the autopilot myth. Some folks chase the perfect system, thinking they can just press a button and make money. But markets are alive. A strategy that works today might fail tomorrow. These lessons go way beyond trading. Whether it's personal finance or career moves, there's no magic fix. Just smart, flexible strategies built on logic. Even more important, the book teaches you to think in probabilities. Elder says trading is like poker. The best players don't win every hand. They just know when the odds are in their favor and when to step back. This flips our instincts upside down. Most of us want certainty. We crave that 100% win rate. But real winners? They accept that mistakes happen. What matters is having rules to limit losses. One of his most famous ideas, the 2% rule. Never risk more than 2% of your total account on a single trade. That number isn't random, it's survival math. Even if you're wrong 5 times in a row, you still keep 90% of your money. You live to fight another day. This kind of thinking applies everywhere. Don't dump all your savings into one investment. Before quitting your job, make sure you've got 6 months of expenses saved. At its heart, it's about using probability to manage risk. You might say, these ideas sound simple, why read a whole book? Here is why. Elder's genius is turning being rational into actual steps you can follow. He doesn't just say, control your emotions. He shows you how to keep a trading journal, logging not just what you did, but why and how you were feeling. It's like doing surgery on your own psychology. He doesn't drown you in complex indicators. He tells you, use moving averages in trending markets, RSI and sideways ones, so you can actually see the crowd's psychology behind the charts. His famous triple screen system? First, check the weekly chart to spot the big trend. Then zoom into the daily for entry points. Finally, use a shorter time frame to confirm timing. The core idea: use multiple angles to avoid blind spots, and that works in any decision-making situation. By now, you probably get it. Trading for a living isn't really about trading. It's about mastering your mind. It helps you see why, even when you know chasing highs and selling in panic is wrong, you still do it. Why some people stay calm and buy during crashes, while others run for the exits at the peak. The answers? They're buried in our mental patterns. Next, we'll dive into those inner demons, the emotional traps that sabotage your decisions, and how to recognize them, face them, and finally break free. What is trading really? Some say it's a game of buying low and selling high. Others say it's a battle against the market. But Alexander Elder pointed out sharply in his book that trading is, at its core, a contest between people. It's not just about fighting the market, but about wrestling with your own mind. If you want to make money in trading, you first have to understand human nature. First, let's talk about why you lose control every time you trade. There are 5 deadly traps in individual psychology. Retail traders rarely lose money because they don't understand the techniques. They lose because they get trapped by their own thinking. Elder, being a psychiatrist, has seen countless traders expose their psychological flaws in the market. He summed them up into 5 of the most common mental traps. First, the myth of the secret formula. People always think there's some magic key, and end up becoming the suckers. Many beginners believe that experts must have some hidden secret, and if they can just find it, they'll make easy money. So they spend thousands on magic indicators or follow some so-called master. In the end, they find out that those secrets are either outdated or just scams. Elder exposed the truth. There are no secrets in trading. Making money comes from rational analysis and discipline. Just like driving doesn't require magic, only understanding the rules and practice. The core of trading is reading the trend and managing risk, not finding shortcuts. The people selling secrets aren't making money from trading. They're making money from those who want shortcuts. Second, the not enough money myth. Thinking that having more money means you'll win, that's one of the biggest illusions. A reader once asked Elder, "I only have $6,000. Am I losing because my capital's too small? If I had $60,000, I'd definitely make money." Elder asked him back, "Do you realize that people with more money often lose faster? Because when you have more, you take bigger risks. One big position, one market swing, and you're wiped out." The truth is, losing money has nothing to do with how much capital you have. It's about position management. Even if you only have $10,000, as long as you risk just 2%, $200 each time, you could be wrong 5 times in a row and still have over 9,000 left. But if you start with half your capital in one trade, one mistake, and you're down to 5,000. The key to trading isn't about having enough money. It's about having the courage to control your risk. Third, the autopilot myth. Believing in automatic trading systems is worse than trusting your own driving skills. Many people dream, "If only I had a system that could buy and sell for me, I'd make money while I sleep." But Elder revealed the truth. The market is alive. What worked yesterday might fail today. It's like the weather. Yesterday's outfit guide doesn't work when the season changes. Market trends, volatility, and crowd emotions are always shifting, and no mechanical system can keep up. The only reliable way is to treat systems as assistants. Let them calculate indicators for you, but keep the decision-making in your own hands. Just like with autopilot, no matter how advanced it is, the driver must always be ready to take control. In trading, human judgment will always matter more than a machine's command. Fourth, the guru worship trap, treating trading masters like gods and ending up as their bag holders. There are always prophets in the market. Some claim to predict tops and bottoms precisely. Others get famous for their wave theories. But Elder followed countless so-called masters and found a pattern. They rarely stay on top for more than one cycle, usually about 4 years. Because market styles change. What worked last year might be totally useless this year. What's even more ironic is that when a theory gets popular, its predictions become self-fulfilling. Everyone buys because everyone else does. And yes, prices go up. But once the market turns, those followers are the first to lose. Remember, no one can predict the market forever. Instead of believing in a guru, believe in yourself. Fifth, self-destructive trading, using trading to escape reality and ending up sinking deeper. Elder saw one of the saddest cases. An engineer who wasn't happy with his job started using trading as an outlet. When he made money, he felt smarter than his boss. When he lost, he doubled his positions to win back his pride. In the end, he lost all his savings and his job. That's what self-destructive trading looks like. That's self-destructive trading. Treating trading as an emotional outlet instead of a rational investment. It's like someone trying to drown their sorrows in alcohol. The more they drink, the worse it gets. People who use trading to escape reality just sink deeper into a cycle of excitement and despair. How do you break free from these traps? Elder got his inspiration from Alcoholics Anonymous. The first step is admitting you've lost control. Just like an alcoholic must admit they can't fight alcohol, a trader must admit they can't fight greed and fear. Only then can you set rules to control yourself, like stop losses and position limits. Second, let's talk about how the market isn't a machine. It's a crowd of emotional people. There are 3 basic rules of crowd psychology here. Understanding your own mind isn't enough, because market prices aren't just objective numbers. They're the sum of everyone's emotions. It's like a crowd in a square. Some are shouting up, others down, and the final agreed-upon price is simply the result of that collective emotion. Only by understanding crowd psychology can you see the truth behind prices. First, price is a compromise between buyers and sellers, not the true reflection of value. Some people say prices reflect value, but Elder gave an extreme example. During the Great Depression in 1929, a stock sold for $100 one day, and the next day when nobody wanted to buy it, sold for just $1. Did that company really lose 99% of its value overnight? Of course not. The price was simply what the most eager buyer and seller agreed on at that moment. For example, if a buyer's highest offer is 10 yuan and a seller's lowest price is 12, there's no deal. Only when the buyer compromises to 11 and the seller accepts 11 does the trade happen. And that's how the price is formed. So when you look at prices, don't ask whether it's worth it. Ask which side is more desperate. When buyers are desperate, prices rise. When sellers are desperate, prices fall. Second, crowd behavior is emotional, simplified, and tends to go to extremes. There's a rule in crowd psychology. Once a person joins a group, their IQ tends to drop. When you're alone, you might calmly analyze whether a stock is worth buying. But when everyone around you is shouting, "The bull market is here," you'll probably rush in with them. The market crowd works the same way. When prices go up, people cheer each other on. Even when prices are already high, they think it'll go higher. That's greed. When prices fall, people spread panic. Even when prices are already low, they think it'll drop lower. That's fear. This is why the top of the market is always full of madness, and the bottom is full of despair. Crowd emotions magnify greed and fear, pushing prices far away from rational value. Third, don't be one of the sheep. Be the person standing outside the herd watching. You can make money following trends, but don't be the last one to jump in. Elder's advice is simple. When the crowd goes crazy, keep your distance. When the crowd goes quiet, start paying attention. For example, before the 2008 financial crisis, everyone was buying subprime products, believing housing prices would rise forever. That's when the crowd was the craziest, and that's when you should have pulled out. In 2009, when the market hit bottom and no one dared to buy, when the news was full of collapse headlines, that was when the crowd was most desperate, and that was the real opportunity. Remember, you can make money in the middle of a trend, but both the top and the bottom are traps. Third, let's talk about why you always seem to go against the market. The link between individual and crowd psychology. It's like a drop of water and a wave. Your emotional decisions get amplified by the crowd's emotions, and that's when things turn disastrous. For example, you plan to cut your loss at 5%. But when everyone around you said it would rebound, you couldn't resist holding on. Then suddenly the crowd's mood flipped. Everyone started selling, prices dropped 10%, and your loss got even worse. That's a classic case of an individual getting hijacked by the crowd. The key to breaking free is setting anti-emotional rules. On the individual level, you need to write your trading plan in advance. How much to buy, where your stop loss is, and follow it strictly. Don't let temporary emotions change your mind. On the crowd level, when you see everyone talking about the same stock, ask yourself, are they getting too excited? That's how you avoid chasing the highs and selling the lows. Understanding human psychology is just the first step in trading. The next thing you have to figure out is how to use tools to measure those emotions and trends. Just like how a doctor first understands the cause of illness, then uses instruments to diagnose it. Traders need technical analysis tools, charts, indicators, to turn crowd psychology into visible signals. In the next part, we'll break down these tools. Not to teach you how to calculate formulas, but to show you the psychology behind each indicator, so you can truly understand what the market is trying to tell you. If psychological analysis is about understanding what traders think, then technical analysis is about reading the market's expressions. Charts, indicators, and volume are basically the external reflections of collective psychology, like someone's micro-expressions that reveal their true emotions. The small details in price movement tell you who's in control, buyers or sellers. Elder emphasized that technical analysis isn't fortune-telling, it's translation. It translates price movements into shifts in buying and selling power, helping you decide whether to get in or get out. Now let's break down the core tools. The key isn't memorizing formulas. It's understanding the group psychology behind them. First, let's talk about traditional chart patterns. They use price trajectories to read the crowd's consensus. Early traders didn't have computers. They drew charts by hand to analyze the market. And those old-school methods still work today because they captured the repetitive nature of group behavior. Rule number 1. Support and resistance are the market's psychological defense lines. Support means when prices drop to a certain level, they bounce back, like an invisible hand holding them up. That's because a lot of people bought there before and don't want to sell at a loss. When prices return to that level, they buy more to average down, strengthening the buying side. Resistance means when prices rise to a certain point, they fall back, like hitting a ceiling. That's because many sold there before and made money. When prices return, they rush to take profits, strengthening the sellers. In practice, don't blindly buy at support unless volume increases. It means real buyers are stepping in. And don't chase prices at resistance unless volume surges on the breakout. It means buyers are truly strong. Rule number 2. Trend lines are the compass of crowd consensus. Draw a line connecting price lows or highs, and you'll see the market's general direction. An uptrend line means each pullback doesn't break the previous low. Most people believe it'll keep going up, so buying on dips is safer. A downtrend line means each rebound fails to break the last high. Most believe it'll keep falling, so shorting on rallies makes more sense. Here's a key tip. The steeper the trend line, the more dangerous it is. A near vertical move means the crowd's too emotional. What goes up fast comes down fast. A smoother, 45-degree trend line is more stable and shows rational sentiment. Rule number 3. Classic patterns show the battle between bulls and bears. Price moves form shapes like the head and shoulders, triangles or flags. They're just visual results of that fight. A head and shoulders top looks like a person's outline. One head, two shoulders. It means buyers were strong at first, but they lost momentum, and sellers are about to take over, a sell signal. A triangle pattern means price swings are getting narrower, like a spring being compressed. The longer it's compressed, the stronger the breakout that follows. The breakout direction marks the new trend, but never look at the pattern alone. Combine it with volume. If volume expands on the breakout, it's real participation. If it doesn't, it might be a fake out. Don't fall for it. Next, let's talk about computer indicators. Let the data help you stay calm. Indicators extract price patterns quickly, but more isn't better. Elder divides them into two main categories, and understanding these two is enough. The first category is trend-following indicators. They capture the big direction, best used in trending markets, showing whether the crowd consensus is still intact. The moving average, or MA, for example, a 13-day MA, is just the average price over the past 13 days. It filters out short-term noise so you can see the bigger picture. When the MA is sloping upward, it means most people believe today's prices are higher than before, and could go higher. When it's sloping downward, people believe prices are cheaper, and could drop more. In practice, if the price is above an upward-sloping MA, go long. If it's below a downward-sloping MA, go short. The MACD indicator is more sensitive. It shows the momentum behind the trend. When the MACD bars grow taller, it means buyers are getting stronger, or sellers are getting more aggressive. When the bars shrink, it means the trend's losing steam. The second category is oscillators. They help you catch turning points. Great for sideways markets, showing if crowd sentiment is too extreme. The stochastic indicator, KDJ, ranges from 0 to 100. Above 80 means buyers are too excited. Price might pull back. Below 20 means sellers are too fearful. Price might bounce. The logic is like a pendulum. When it swings too far left, oversold, it swings back right. Too far right, overbought, it swings left again. The RSI works similarly, but is more stable. When price makes a new high but RSI doesn't, that's a bearish divergence. It means buyers are running out of strength, a potential drop ahead. When price makes a new low but RSI doesn't, that's a bullish divergence. Sellers are running out of steam. Next, let's talk about volume and open interest. They reveal how committed the crowd really is. Price shows surface emotion, but volume and open interest show real action. It's like judging someone, not just by what they say, but by what they actually do. First, volume. It measures how heated the crowd's emotions are. When prices rise with increasing volume, it means lots of people are truly buying. The trend's reliable. If prices rise but volume shrinks, only a few are buying. The trend might be fake. When prices fall with high volume, people are really selling. The downtrend will likely continue. If prices fall but volume drops, few are selling. It might be near the bottom. And if volume suddenly spikes to twice the normal level, be careful. The crowd might be too emotional. That often marks the end of a trend, like a stock hitting its daily limit up on huge volume. Someone might be quietly selling. Now, open interest. It measures how fierce the bull-bear battle is. It only exists in futures or options markets, meaning the number of contracts still open. When prices rise and open interest increases, new buyers and sellers are entering. The argument's getting louder, and the uptrend can continue. When prices rise but open interest drops, it means bears are giving up and leaving. The rally's probably near its end. Fewer people arguing means the noise dies down naturally. Dr. Elder warned that 90% of traders fail because they use too many tools and end up with confused logic. Some people watch 10 indicators at once. When the price goes up, they pick the bullish ones to justify. When it drops, they find bearish ones to comfort themselves. Eventually, the indicators follow the price instead of the other way around. Remember 3 principles. 1. Use trend indicators, like MA and MACD, only for trending markets. Don't use oscillators there, or you'll get shaken out by overbought or oversold signals. 2. Use oscillators, like KDJ and RSI, only for sideways markets. Don't use trend indicators or you'll get trapped in false breakouts. 3. Cross-check with multiple time frames. If the daily chart looks bullish, check the weekly too. Bigger time frames are always more reliable. Understanding tools is like learning words. You still need grammar to form sentences. That grammar is your trading system. Like a chef with ingredients, you still need a recipe to cook a dish. In the next part, we'll break down Elder's classic triple screen system. It shows how to connect trend indicators, oscillators, and volume into one full rule-based system: when to buy, when to sell, and how much to risk. That's how technical analysis turns from scattered judgment into an executable plan. Learning psychological analysis and reading technical indicators is like a chef having all the ingredients and seasonings, but no recipe. You still can't make a good dish. Trading is the same way. Scattered knowledge won't guarantee steady profits. You need to link trend analysis, entry points, and stop-loss rules into a fixed set of rules. That's a trading system. Elder said a good trading system is like a GPS. You don't have to constantly worry about where to go. Just follow the preset rules and reduce emotional decisions. His most used system, the triple screen, twists indicators of different time frames and types into one rope, filtering out noise and leaving only high-probability trades. 1. Why do you need a trading system? Because retail traders easily fall into chaos. A trader without a system is like someone lost in the forest. Price rises, and they want to chase. Price drops, and they want to cut losses. They're completely led by the market. Elder has seen so many cases. Some see bullish signals on moving averages but don't buy because stochastic indicators say overbought, and they miss the move. Some see a downtrend but buy the dip on a hunch and get stuck halfway. The root problem is no priority rules. When indicators conflict, they don't know which to trust. When the market moves, they don't know whether to go or retreat. The core purpose of a trading system is to define rules. When you must buy, when you must sell, which signals are reliable, which you can ignore, how much you can lose, how much you aim to make, and when to step aside. 2. The triple screen system uses 3 layers to catch high-probability trades. This is Elder's original system, named after the logic of filtering. First, look at the big picture, then find the precise timing, and finally confirm the signal. 3 layers of checks reduce mistakes. Layer 1 uses the weekly chart to define the big direction. Don't fight the trend. The goal is to identify the main current of the market and trade only in its direction. For example, if the weekly chart is bullish, only consider buying. If it's bearish, only consider selling. The tool is the weekly MACD histogram, a trend-following indicator. When the weekly MACD slopes up, most people are bullish long-term. Enter buy-only mode. When it slopes down, most are bearish. Enter sell-only mode. The key is, if the big direction is wrong, even the best techniques fail. It's like sailing. Downstream, you move forward even slowly. Upstream, you might go backward no matter how hard you row. Layer 2 uses the daily chart to find entry points. Get on during a pullback, get off during a rebound. The goal is to find the most cost-effective entry after confirming the big trend. For example, if the weekly chart is bullish, wait for the daily chart to pull back to support before buying. Avoid chasing highs. The tool is a daily oscillator, like stochastic. Weekly bullish plus, daily oversold. Stochastic 30. Mod short-term pullback is a buy. Weekly bearish plus, daily overbought. Stochastic 70. Short-term rebound is a sell. The logic is, within a big trend, there are always small swings. Oscillators help you know when the swing ends. It's like waves. You wait for the water to recede before boarding, not jumping on the crest. Layer 3 confirms breakouts intraday. Don't get fooled by fake moves. The goal is to filter out false signals and make sure the trend really starts. For example, the daily chart looks bullish, but the price hasn't moved. It might be a trap. The method is a trailing stop order. Place your buy above the previous day's high. Only if the price actually breaks above does the order execute, showing buyers are really pushing. Place your sell below the previous day's low. Only if it breaks does it execute, showing sellers are really acting. This avoids buying then dropping, selling then rising. The market often fakes both sides, and breakout confirmation helps you dodge those traps. The triple screen is good for trending markets with swings. Elder also introduced 2 specialized systems for different market conditions. First, the parabolic system catches fast moves up or down. It follows the price to chase highs or cut lows, but uses a trailing stop to protect you. For example, after buying and price rises, the stop moves up like a parabola. If the price reverses and hits the stop, it sells immediately. It works for strong one-sided moves, like consecutive limit-ups after sudden good news, letting you ride most of the trend. But in sideways markets, it can trigger frequent stops, use carefully. Second, the channel system works in sideways markets. Draw two parallel lines, upper and lower. Buy at the bottom, sell at the top, like a swing in a range, earning from volatility. The channel width must cover about 90% of price movement. Too narrow? Chaos, too many trades. Too wide. Miss opportunities. Elder emphasized that a good system is a tool, not a dogma. Remember 3 principles when building one. Keep it simple. 3 to 5 indicators are enough. The more you add, the more conflicts, the more confusion. Leave some margin. No system is 100% right. Accept occasional mistakes. The key is to make more when you're right and lose less when wrong. Fit yourself. Impatient people shouldn't use long-term systems. Conservative people shouldn't use aggressive systems. Like shoes, fit matters more than looks. A trading system tells you when to buy and sell, but there's an even bigger question. What if you're wrong? Even a system with 90% win rate has a 10% chance of losing. If one mistake wipes your capital, no system can save you. Next, we'll focus on risk management. It's the lifeline of trading. Elder said, beginners think about making big money. Veterans think about surviving. Learn to use the 2% rule to control losses and lock in profits with stop loss and take profit. That's how a system truly works, letting you stay in the market longer and earn steadily. Here's a harsh truth in trading. 90% of people lose money, not because they don't understand the technical stuff, but because they fail at risk management. It's like driving. No matter how good you are, it won't save you if you don't wear a seatbelt. Technical analysis helps you pick the right direction. Risk management keeps you from crashing. Elder repeatedly stresses in his book, the primary goal of trading isn't making money, it's staying alive. You have to protect your capital first. Only then can you wait for profitable opportunities. The most common mistake retail traders make is treating trading like a gamble. If they win, they double down. If they lose, they hold on hoping for a rebound. But the market is a game of probabilities. Even a system with 90% win rate can be wrong once in 10 trades. If you blow up your capital that one time, all 9 wins before are wasted. Elder saw an extreme case. A trader started with $50,000, made $300,000 in 6 months, but then added to a losing position against the trend, and, in 3 days, lost all the profits and half his principal. His problem wasn't poor technique. It was greed when winning and stubbornness when losing. That's the deadly effect of emotions on risk management. There are 2 key points to break the emotion trap. First, accept losses as normal. Like surgeries have failure rates, trades won't be right every time. Treat each loss as a business cost, not a reflection of your ability. Second, replace feelings with rules. Decide in advance how much you're willing to lose. For example, risk only 2% of your capital per trade. No matter how certain the trade looks, don't break this rule. Money management isn't about how much you can make. It's about how much you can afford to lose. Elder's most respected rule is the 2% rule. Every trader can learn it. The 2% rule means a single loss never exceeds 2% of your capital. The logic is, even if you're wrong 5 times in a row, you only lose 10% of your capital. 90% remains to keep trading. But if you lose 10% each time, after 3 mistakes you're down to 70%, and you need a 43% gain just to break even. Difficulty doubles. For example, with a $100,000 capital and max loss per trade of $2,000. If a stock costs $10 and your stop loss is $9 on 10% loss, you can buy $2,000 shares. 2,000 shares x $1 loss spars $2,000. If your stop is $9.50, 5% loss, you can buy $4,000 shares. The stricter the stop, the bigger the position you can take. This is the risk position balance. But many people, after a loss, want to buy more next time to make it back. Lose $2,000, next trade $4,000, then $8,000. It's like Russian roulette. Eventually, you hit a bullet. Elder warns, the market doesn't forgive stubbornness. The right approach is, after a loss, reduce position, wait for the system to give a reliable signal, then slowly build back up. Like driving, hit a pothole, slow down first, then accelerate gradually. Also, Elder says diversification isn't just buying more stocks. It's not putting all your eggs in one basket. Some think buying 10 stocks is diversification. But if they're all in the same sector, like all in new energy, they'll still fall together. True diversification is cross-market. Mix stocks, futures, bonds, or combine trend and swing strategies, or pick non-correlated instruments within the same market. For example, buy some gold and a smaller amount of oil. They often move opposite each other. Once your money rules are set, you also need dynamic risk management. Use stop losses to limit losses and take profits to lock in gains. 1. Stop loss. Know your max loss before entering. A common rookie mistake. Buy first, think later. Wait to stop loss until it's already down. 5% loss, they hesitate. 10% even more. End up deeply trapped. The right approach. Set the stop loss before entering. For example, place it just below the recent support or previous low, or use a fixed percentage like 5%. Place your order with the stop loss simultaneously, so the system executes automatically. The key is that cutting losses isn't admitting defeat. It's trading a small price for the chance to keep playing. Just like in Texas Hold'em, folding when you have a bad hand preserves your chips so you can wait for a better one. 2. Take profit. Don't let the cooked duck fly away. After making money, people often make 2 mistakes. Either sell too early out of fear of a pullback and miss the big move, or get greedy waiting for more. Then profits get wiped out. Elder's 50% rule. If you make $10, lock in $5 first. Set take profit at $5, then gamble the remaining $5. This way you secure part of your gains without missing out on bigger profits. Advanced technique. Use a trailing take profit. For example, if a stock rises $10, move your take profit from $5 to $8 following the price up. It's like holding profits by the hand. Walk forward and release when it drops. Many forget after a trade. Every loss is tuition. Elder recommends keeping a trading journal to record 3 things. 1. Trade details. Why you bought, stop loss, position size. 2. Emotional changes. Did you buy impulsively? Did you hold too long? 3. Improvement space. If you did it again, would you set a tighter stop, reduce position? For example, someone found in their journal they always bought impulsively in the 10 minutes before the open, afraid of missing out. And 80% of their losses came from that period. After changing to trade half an hour after open, losses were cut in half. This is the value of review. Risk management isn't a one-time task. It's a habit you constantly refine. Even if you master the 2% rule, new issues come up. How to adjust stops in sudden market moves. Will you get careless after consecutive wins? These all require continuous optimization. Next, we'll talk about the advanced path in trading. How to go from surviving to consistently profiting. This requires not just skills and risk control, but also cultivating the right mindset. No greed, no panic, no overreaction. Like a seasoned hunter, patiently wait for the right shot and act precisely. After all, the highest level of trading isn't beating the market, it's managing yourself. When you close trading for a living, you realize Elder is never really talking about predicting the market. He's talking about dealing with yourself. The magic of trading is that it's like a mirror. When you're greedy, the market slaps you with a crash to wake you up. When you're fearful, the market bounces and makes you regret not buying. When you're lucky, the market traps you to teach a lesson. Many people think mastering the technical stuff is enough to make money, but real pros know. Technical skills are weapons, self-awareness is inner strength. Without that inner strength, even the sharpest weapon can hurt you. Elder himself is the best example. When he immigrated from the Soviet Union to the US, he knew nothing about trading. But with the sensitivity of a psychiatrist, he noticed why traders lose money. It is the same logic as alcoholism. Knowing it's wrong, but still unable to stop. The alcoholic says, "Just one more drink." The trader says, "I'll hold one more day." Alcoholics escape reality with booze. Traders fill emptiness with trades. He applied the 12-step principles of Alcoholics Anonymous to trading. The core idea is simple. First, admit you can lose control. Only then can you use rules to restrain yourself. This is the first layer of self-awareness, seeing your own psychological traps. Do you wait to buy until the price has already risen? Do you pretend not to see losses? Do you brag when you make a little and stay silent when you lose big? These behaviors are all human weaknesses. Greed makes you chase highs. Fear makes you cut losses. Luck makes you hold on. Trading systems and risk management are essentially designed to fight these weaknesses. Use the 2% rule to curb greed, stop-loss orders to lock in fear, and trading journals to tear apart luck. On a deeper level, trading teaches you self-awareness. It teaches you your own limits. Elder has seen too many smart people stumble. Engineers build complex models to predict prices, only to get slapped by a simple trend. Professors analyze markets with economic theory, yet lose to a grandma chasing highs and selling lows. The reason is simple. They think they understand the market, but they don't realize the market is inherently unpredictable. Real traders admit they don't know everything. They don't aim to be right every time. They aim to make more when they're right and lose less when they're wrong. They don't fantasize about catching every move. They focus only on opportunities they understand. Like an old fisherman who won't go out in a storm. A real trader knows when to step back if they don't understand. This sense of knowing when to advance and retreat is the clearest recognition of your own abilities. The most amazing part, this self-awareness spills over beyond trading. You'll find that position management logic helps you plan your family budget, reminding you not to put all your money into high-risk investments. Techniques to control emotions help you handle work stress and avoid making decisions in anger. Accepting uncertainty helps you face life's ups and downs, reminding you that not every effort pays off immediately. At the end of the book, Elder says becoming a trader is a lifelong practice. The core of this practice isn't how many indicators you learn or how many patterns you memorize. It is slowly realizing that your opponent in trading is never the market. It's the impulsive, greedy, lucky version of yourself. When you can resist greed when prices rise, stay calm when prices fall, and accept losses when you're wrong, you win. Not against the market, but against yourself. And maybe that's the most precious gift trading for a living leaves to ordinary people. It teaches you, if you can manage yourself, you won't do too badly in anything. And finally, congratulations, you've finished another book.